What is SIP? How SIP builds wealth over time? A simple question most people never ask. Let me ask you something important. What if building wealth didn't require perfect timing? What if you didn't need deep market knowledge, daily tracking, or constant decision-making? What if an ordinary salary earner, someone with responsibilities, bills, and limited time, could quietly build real wealth over the years? No stress, no fear, no guessing. That system already exists. It's called SIP. Yet most people either misunderstand it, underestimate it, or ignore it completely. Not because it doesn't work, but because it looks too simple. Welcome to Wealth Principles Lab, where we don't sell motivation, we explain how money really works. What SIP actually means in real life. SIP stands for Systematic Investment Plan. In simple words, SIP means investing a fixed amount of money at regular intervals, usually every month, into mutual funds. You don't invest once. You invest consistently. You don't wait for the perfect moment. You invest through all market conditions. SIP is not a product you buy. It is a system you follow. A system designed to replace guessing with discipline, emotion with structure, and confusion with clarity. Most people think investing is about being smart. In reality, investing is about being consistent. Why SIP exists in the first place? To understand SIP, you must first understand human behavior. Most people don't lose money because markets are bad. They lose money because behavior is bad. People wait for the right time. They invest when markets feel safe. They stop investing when markets fall. They panic when news looks negative. This emotional cycle destroys long-term returns. SIP was created to solve this exact problem. With SIP, investing happens automatically whether markets are high or low. No second guessing. No fear-based decisions. No emotional timing. This one design choice changes everything. How SIP works behind the scenes every month, when your SIP amount is invested. Your money buys mutual fund units at the current market price. When markets are high, your money buys fewer units. When markets are low, your money buys more units. Over time, this balances your purchase cost. You are not trying to buy at the lowest price. You are trying to buy at an average price. This concept is often called rupee cost averaging, but you don't need fancy terms. Just remember this: you stop trying to be smart and start being disciplined. And discipline beats intelligence in investing. Why consistency matters more than market timing. Most people believe success comes from timing the market. But timing requires experience, emotional control, constant attention. Most people don't have these. SIP removes timing completely. Instead of asking, "Is this a good time to invest?" you ask, "Am I staying consistent?" This shift alone improves outcomes dramatically. Markets will go up, markets will go down. Consistency keeps you invested long enough for growth to happen. The real power of SIP, compounding over time. At the beginning, SIP feels slow. You invest for 1 year, nothing dramatic happens. You invest for 2 years, still feels small. This is where most people quit. But SIP is not built for excitement. It is built for compounding. Compounding means your money earns returns. Then those returns start earning returns as well. At first, growth is invisible. Later, growth becomes exponential. Time is the real engine. The longer you stay invested, the harder your money works for you. A simple example that changes perspective: imagine an ordinary person investing a modest amount every single month. Nothing aggressive, nothing complicated, just a small, fixed amount invested with discipline. Some months the market goes up, other months it goes down, but this person stays consistent. They don't stop during market crashes. They don't chase the latest hot fund. And they don't panic when headlines turn negative. Years pass quietly. No excitement. No dramatic moves. Then, after 15 to 20 years, they look at the final value and it genuinely surprises them. It's not because they earned more or worked harder, but because time and discipline did the work for them. The wealth wasn't built through effort or intelligence. It was built through patience and consistency. This is the quiet power of SIP: slow, steady, and extremely effective over long periods. Why SIP is perfect for salary earners. SIP fits naturally into everyday life, especially for salary earners. Income comes every month, and expenses are monthly as well. So investing monthly feels practical and manageable. Instead of trying to save whatever is left at the end of the month, SIP encourages you to invest first and adjust spending later. This simple habit creates long-term stability. Over time, it quietly separates those who remain financially stressed from those who build confidence and security. SIP turns saving into investing automatically. No stress, no pressure, and no daily decisions, making wealth building a natural part of life rather than a constant struggle. SIP versus lump sum investing. The practical reality: lump sum investing requires timing and emotional control. If you invest everything at once and markets fall, panic begins. SIP removes this pressure. Instead of one big decision, SIP creates many small, disciplined decisions over time. For beginners and busy professionals, SIP is usually the safer and smarter approach. Not because returns are higher, but because behavior is better. Risk, markets, and the truth people avoid. Here's an important truth. SIP does not remove market risk. Markets will rise. Markets will fall. What SIP removes is behavioral risk, fear, panic, and emotional mistakes. Most people fail not because investments are bad, but because they stop at the worst possible time. SIP rewards patience. SIP punishes impatience. Inflation and why SIP matters more today. Saving money alone is no longer enough. Inflation quietly reduces purchasing power every year. Money sitting idle becomes weaker over time. SIP helps money grow faster than inflation over long periods. Saving protects money. SIP protects value. This difference matters more than most people realize. Why SIP feels boring, and why that's a strength. SIP is boring. No thrill, no excitement, no daily checking. And that's its biggest advantage. Fast money stories are allowed. Real wealth is built quietly. SIP is a system for people who value peace over panic, discipline over drama, and results over noise. How to use SIP the right way. Most SIP failures don't happen because SIP doesn't work. They happen because people misuse the system. SIP is simple, but it demands discipline. The biggest mistake investors make is stopping their SIP when markets fall. Market declines are not a signal to stop. They're exactly when SIP works best. Another common mistake is chasing returns, switching funds, just because something else is performing better in the short term. SIP is not designed for quick wins. It rewards patience, not urgency. The right way to use SIP is surprisingly simple. Stay consistent, even during bad market phases. Treat SIP like a non-negotiable expense. As your income grows, gradually increase your SIP amount instead of upgrading lifestyle immediately. Most importantly, give time the space to do its job. SIP is not a shortcut or a trick. It is a long-term system designed to work slowly and reliably. Common mistakes people make with SIP. Many investors unknowingly damage their own results. They stop SIPs during market crashes, skip monthly contributions, withdraw money too early, or frequently change funds based on recent performance. These actions break the compounding process. Compounding only works when money stays invested for long periods without interruption. SIP performs best when it feels boring, repetitive, and uneventful. How long SIP really needs to work. SIP is not meant for short-term goals. Its real power becomes visible over long durations: 10 years, 15 years, or even 20 years. Short time weakens SIP's impact, while long time multiplies it. The longer you stay invested, the greater the reward. The psychology behind SIP success. SIP removes fear, greed, timing, pressure. It creates habit, structure, confidence. This psychological advantage is more important than returns. SIP is not magic. It is a system. SIP is not magic. It is math discipline time, working together. Most people ignore it because it looks slow, but slow systems last the longest. SIP will not make you rich overnight, but it can make you financially strong, stable, and independent over time. This channel, Wealth Principles Lab, exists to teach these quiet systems that actually work. If you want calm, intelligent financial education and long-term wealth thinking, subscribe to Wealth Principles Lab, because wealth is not built fast, it is built consistently,